When you start investing in real estate, you want to get to that point where you're financially independent, which means the money you have coming in from your cash flow is exceeding the amount you were making at your job. But along the way, you realize the reality of that is that cash flow is just a small part of the money that comes in.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers. Learn more at pointcentral.com. Hello and welcome to episode 100. So I am back in the studio today with Charlie Gao. The last time Charlie was here was for episode 96, and we talked about his investing and his self-storage plans. And as Charlie was leaving, he said, well, what are you going to do for your 100th episode? And I said, well, I have no idea. And that's when Charlie suggested, well, why don't you let me interview you for your 100th episode? So I said, great. Let's do it. And here we are today. It's our 100th episode of the show. I'm very proud to have stayed on the air for 100 episodes. They let me do this for that long, and for that I'm thankful. And for all the listeners, and Charlie, I'm just going to turn it over to you and let you do the interviewing today.
All right. Well, thank you, Brian. I'm glad you chose me from the limited pool of candidates that volunteered to do this.
Which were you?
It's basically me, but still, I got 100%, so chosen out of that. So, well, Brian, I've been listening to the podcast. I'm a big fan of it, obviously, but what I am curious is, how did you come to become the host of the RPOA podcast?
So I became the host of the RPO podcast when Clay Powell, I guess he's the CEO of the RPOA, sent me an email and said, hey, we were thinking of doing a podcast. Do you want to host it? And I love podcasts. I just like you, I listen to a lot of them, especially all the real estate ones. And I just, because I love them and I have a little bit of, I have a lot of production background. I thought, what a great thing to do, to be able to just have conversations with other real estate investors and record it so that everyone can listen to it and learn from it. So I jumped on the opportunity. And that was almost 2 years ago. I mean, by the time this episode comes out, we'll have been up for just under 2 years. Wow. And I've loved every minute of it.
So I know you had been doing investing even prior to when you had moved to Michigan, was it?
Yeah. So I had started investing when I lived in LA.
Yeah.
And I won't go into too much detail because I have done that already. But I was investing in out-of-state single family because you could not buy for cash flow in LA at the time. This was early 2000s. People were buying for appreciation, negative cash flow in the Los Angeles and most of California, probably. So I tapped into a network. We were buying properties out of state. I was able to buy single families for anywhere from $1,000 to $10,000 down. And these were good single families in good neighborhoods, in good cities. Rio Rancho, New Mexico, Fayetteville, North Carolina. These were buy and holds, but on paper, they were supposed to cash flow. In reality, some of them did, some of them didn't. I kept running into issues, evictions, tenants who would cause damage or maybe weather-related type damage. And at the end of the day, after I sold everything off, and I have sold off all 7 properties that I bought out of state, I think I might have broken even when you factor in the tax losses that I was able to deduct.
So how did that take you to Michigan today and, investing here in Michigan locally? Because I think I've heard you say in a previous podcast that almost all your assets are primarily in Michigan now at this point, or they may be all.
Yeah, everything I own is actually in Grand Rapids in Wyoming. That's about to change, and we'll talk about that. But everything I own right now is in Grand Rapids in Wyoming. My wife and I moved here in 2005 from Los Angeles. And in 2005, I was looking at the real estate market and what the prices, the astronomical prices, and it was very, very evident in LA because they were astronomical, the prices that people were paying. And I said to my wife, look, if we're going to move, we need to sell, because we had a condo in Santa Monica. we need to sell because there's a bubble and there's going to be a crash. And I was probably 2 or 3 years early. We sold, made a really good profit on a condo that we had owned for about 3 years in Santa Monica. Moved here to Grand Rapids where the market was already in the dumps, and picked up a 5-bedroom house here in Grand Rapids for less than what we sold our 2-bedroom condo.
Is that the house that we're in today?
The house we're in today.
Oh,
yeah.
really? Okay. Okay.
Yeah, my home studio, as I like to call it.
Yeah, I kind of have a bad habit of whenever I go to somebody's house, I look up what they buy it for, and I saw what you got this for. So,
so you can see what.
Yeah, so you've definitely
a
value added on this home for sure.
Yeah,
so.
Yeah, it was a great move, a great bargain. Don't regret it for a second. I mean, we didn't move because of the market, but I just knew that we were going to move, and that was the time to do it. I could tell that a bubble was going to burst, and I waited from when we moved here in 2005 to 2008. And that's when I started buying, after the bottom had come out of the market.
So was real estate the primary driver or why you chose Grand Rapids?
Well, my wife is from this area originally. That was probably the primary reason we looked at Grand Rapids. But when I really thought about where I wanted to be next, and what I thought my ultimate game plan was, which was real estate, I saw that Grand Rapids, even though the market was terrible here, the real estate market was terrible here, and the economy was not so good in Michigan, I could tell Grand Rapids had a lot going on, and it was a good place to get in basically early on in the boom. And it has boomed since I moved here in 2005.
So take us today then. What kind of investor would you classify yourself as right now?
Primarily a commercial, multifamily, and apartment investor.
Okay.
However, I've been breaking out in the past year into an commercial office investment where I'm a passive investor, and we're under contract for a self-storage facility that we hope to close on in January.
So tell us more about those, or if you can. I know you probably can be limited on what you can disclose while you're still pending, but the office building, tell us more about that one.
Yeah, so the office building just came to me. Someone, a business owner in town, had purchased an office building, got a small business loan to acquire it, rehab it. He had a partner in it who wanted to be bought out. So I came in with a chunk of money and bought out his partner, and now I have a decent size equity position in the deal. I'm a silent investor, which is kind of nice because every deal I've done, I've been the primary driver of it. So to just kind of be a passive silent investor is a kind of a nice change of pace for me.
So you have now a storage facility, office building, multifamily. So amongst those classes, is there really much difference in how you evaluate those deals when you look at them? Are you primarily still looking at numbers, or are there special considerations you're giving to each asset class when you're investing to them?
Yeah, that's a great question, because each asset class is very different from the others. But at the end of the day, I'm still looking at net operating income. That net operating income, what amount of money is left at the end of the month after you've collected your income, paid your bills, and before you pay your mortgage. What is that NOI? Because I still value commercial property based on that. And every lender or real estate investor does. However, within those asset classes, there are differences. With multifamily, and we've talked about this a lot on the show, you're looking at NOI, and you're looking at like cost per unit or cost per door. How much is your electric bill per door? How much, is your maintenance per door? With office and that type of commercial, you're dealing with square foot. What is your cost per square foot? And it's a different mindset. And I really had to kind of relearn a little bit about investing. And luckily, I had some people to kind of hold my hand and walk me through it as far as, well, how do you really run the numbers when it comes to office? Because it's very, very different.
If we can go into a little bit more detail, I'm actually a little bit more curious on that, because I am actually very close to acquiring my own office building. And I keep hearing references to it's a very volatile class. If there's a depression or if economy hits, that's going to be one of the worst hit. I've even heard things about how there's been this huge shift away from office buildings because of all the people working from home. So do you typically look for better numbers then when you're looking at office building, or are you looking only in specific class or specific areas?
Well, in this particular investment, and I am by no means an expert in investing in office. I've done it once as a passive investor, but what I looked at was the strength of the tenant. and the tenant was the business owner who had purchased the office building for his own use.
Okay.
That was the important thing, because that is if a business owner buys a building, rehabs it, and moves his entire company into it, you have as long as he has a strong business, you have a very strong tenant who's going to be incentivized to stay there for a long time and continue paying rent. That, to me, is the primary thing. And then that's a huge component of the value of office is what is the strength of the existing tenant and how long do they anticipate staying? I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
So how much time do you spend vetting or doing your due diligence on your partner in a situation like that? Or did you know this person fairly well?
He was referred to me by someone that I've worked closely with and who I trusted. And as far as vetting, I had a couple meetings with the business owner, talked to him, got a sense of his business, the strength of his business, the vision that he had for his business. He impressed me with a strong vision for his company. And the real estate was just a small component of that vision. Mm-hmm. So I knew that, well, I'm investing in this person. I'm investing more so in this business owner and his vision than I am in the office building itself.
What can you tell us about the storage facility transaction that you're currently working on at this point?
So this is a new thing for me too. I had another person who I met through the RPOA, actually through the podcast as well, who came to me with this off-market self-storage opportunity that he had negotiated and found himself. I get a lot of people who show me deals, and I'm somewhat of a dream killer because I'll look at those deals and tear them apart and find whatever fault I can with them. I looked at this guy's deal. I realized pretty quickly, he's found something that makes sense. First of all, it's off market. The price that he was able to negotiate was very fair to both sides, and allowed for, the opportunity to make a good profit for whoever bought it. And that, the more I looked at just the economics of self-storage versus the economics of owning multifamily and apartments, I like the fact that you don't have people living in the units. You don't have plumbing to the storage units. This is an outdoor storage facility. Mm-hmm. It's not climate controlled. So the expense ratio that we're looking at in self-storage is anywhere from 30 to 35%. When you look at multifamily or apartment, you're typically, with the properties that I'm buying here in Grand Rapids, which are typically older, you're looking at anywhere from a 55 to 60% expense ratio. Mm. So just that difference alone really got my attention. And we're under contract. We'll be closing in the beginning of the year. And I think it's going to be an exciting time to get to know what self-storage investing is like. Let's talk for a moment about Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers, and how their exciting technology can help you control property access to vendors and potential tenants. No more time wasted waiting for late appointments or no-shows. Oversee energy usage and analyze data in order to reduce utility and maintenance expenses. Eliminate the cost of keys or rekeying locks. Command higher rents and increase tenant retention, and provide tools for tenants and managers to monitor the property to improve safety and security. And it's all done through cloud technology, utilizing encrypted data and private cellular service. And best of all, the return on investment of installing Point Central's technology is upwards of 25% a year. The future of property management is here, and you can find out more by visiting pointcentral.com.
At this point now, you've gone across multiple asset classes. You've I've heard you making your apartment buildings more as efficient as possible. What do you see as the ultimate goal for you now? I mean, I feel at this point you've kind of hit a lot of your goals. You're able to stay at home and spend a lot of time with your kids. And I noticed that your kids are actually younger. So how are you able to balance that with the goals you have now? And where do you see yourself heading now that I feel like you've hit a lot of the metrics that you want to hit at this point?
I've hit a good number of my goals. I've still got plenty of goals as far as like financial benchmarks I'd like to hit, cash flow numbers I'd like to hit. It's interesting because when you start investing in real estate, you want to get to that point where you're financially independent, and which means you don't have to work at a job, and that the money you have coming in from your cash flow is exceeding the amount you were making at your job. Mm-hmm. But along the way, you realize the reality of that is that cash flow is just a small part of the money that comes in. And once you don't have a job, there's other expenses that you end up having to pay, like healthcare, which is a huge bill. So that goal of being financially independent, I cannot say that I'm close to hitting that yet. It's because, especially when you have kids, the expenses go through the roof. What helps are the paydays in between. And what I mean by paydays are if you have a property that you refi and you can pull some cash out, if you do a syndication and you get an acquisition fee, if maybe there's a property along the way that you can flip to make some more money. These are not steady paychecks like you get at a job, but they're paydays that really help out along the way while you're trying to build that cash flow and that financial independence piece. But goal-wise, I think that I've syndicated 3 times, and I'd like to do some more syndications because I certainly enjoy helping investors get into commercial real estate because I think it's a fantastic asset class to invest in. But not everyone is able to have the time or the just the energy to do it. So I enjoy working with other investors. And by the way, I'm not trying to sell anybody because I don't have a deal that I'm trying to syndicate right now. So I would like to do some more syndications. If it were multifamily and apartment, great. If there's opportunities moving forward in the self-storage area, I'm looking at doing that with my self-storage partner. But this is all in the future. So these are goals that aren't really defined right now, but I'm kind of formulating them as I go along. There's also one of the other things I've tried is note investing.
Oh, yeah.
Hosting this podcast, you meet a lot of interesting people who are doing some interesting things. And I interviewed Gene Chandler over the summer. I can't remember which episode, but he invests in notes. So he and I have done a couple deals together here in Grand Rapids, and we're in the middle of those. So I'm waiting to see how they pay off.
So going back a little bit, you mentioned it. I'm curious about this, obviously, because I still have a full-time corporate job. I think the common metric that people are always saying is, and you tied on to this too, there's a lot of other considerations, is I will quit my job once I've replaced my income with my rental income. But then, like you said, there's healthcare costs, and do I go by my salary or do I go home by my take home from what's actually getting direct deposited into my account? So how would you really break that down? What do you think makes sense for the investor that's looking to get their corporate job now? Obviously, some of it's individualized to the specific person, but what advice would you give that person?
So the advice I would have for someone with a corporate job who's looking to retire on real estate is, if you're serious about that, you have to be in it for the long haul. It's not an overnight thing. No matter what, no matter what you're told, it takes a long time. It took me well over 10 years to get to the point where I felt comfortable enough to leave my job. And I had a good job. I had the golden handcuffs where I was making a good living, getting paid pretty well to do something that I enjoyed quite a bit. I was incentivized to leave that job. I had the reason for wanting to leave my job, which was I wanted more time because I was telecommuting for a company in California. So just that time difference alone really cut into my family time. And with children, I had toddlers at the time, but I knew I can't be working till 9 o'clock. So I had that reason. It was like I want to spend more time with my family. I want to have the freedom to do things on my own schedule.
Yeah, I think I remember I tried to schedule the podcast later in the evening, and you said like, "Oh, I can't. I got to make dinner for the kids." Yeah. I really admired that you were. I mean, everything you do, you really have it planned around what maximizes the most time with your family. So that I think honestly, if I were to say one of the things I admire most about you, it's not that I think you're a successful investor, is that you really stick to those values, basically, as being with your family as much as possible.
Yeah, I try to schedule things, business activities during the day. Mm-hmm. I'm usually done with any business activities by 4 o'clock. Mm-hmm. Doesn't mean I'm not still working or returning emails or whatever, but as far as like meetings or...
So what's next for you then?
The nice thing is I'm seeing a lot of opportunity in different directions. Mm-hmm. When I was syndicating and when I have syndicated apartment buildings, that's taken up a lot of my focus. Because I'm the primary driver of that. I'm finding the deal, sourcing a deal, negotiating it, finding the financing, finding the investors to do the deal. That's kind of what I've done, and I'll probably still continue doing that to some extent. But if you look at the deals I've done in the past year, it's really been investing in other people, whether it be the notes that I purchased through someone else who's done the work, or the office building, where I'm a passive investor, or even the self-storage where my partner's really been the primary driver on that. I'm investing in other people now. So that's kind of where my focus is. I think that's what's next. And at the same time, keep doing the podcast, because this takes up a lot of time, believe it or not, doing a podcast.
So what does your real estate team right now look like? Do you have an assistant that works for you full time? Do you have a contractor on staff that handles, I know you have property management. What does that look like right now?
Yeah. So I do not have employees. Okay. I'm kind of a one-man band. My team, but I do have a team. And my team consists of the management company that I use, which is Green Property Management, who they manage all of my properties, and you hear them advertised on the show. They have the maintenance staff that I know I can trust, the leasing agents who do a great job filling my units and managing the properties, the back-end administrative staff, keeping the books and handling all the details of managing and running these properties and just taking care of the properties in a way that I know I can feel comfortable knowing that we're really looking at the big picture and taking a holistic view of the properties rather than just kind of milking them to get as much money out of them as we possibly can at the moment. Mm-hmm. That's a big component of my team. I have my CPA team I've been in contact with quite a bit recently with the self-storage, just helping me figure out how to structure the acquisition price and some of the tax ramifications of that. I have attorneys. I use a lot of different attorneys depending on what the issue is that I need help with. I have a bookkeeper, an independent bookkeeper who does my books. Just being able to take all of my bills and put them in an envelope, mail them to my bookkeeper twice a month and have her pay the bills and follow up on things, make those phone calls to whatever, the utility companies or whatever. That frees up a lot of my time, and it's worth every single penny because I'm now kind of in the commercial leasing world with the office building and then with one of my apartment projects, which has a restaurant space and some other retail space. I've been dealing with a broker, a very good brokerage firm here in Grand Rapids. I also have a very good architect I've been working with on that as well. It's just finding people who are very good at what they do.
I actually have multiple lawyers too as well. I call on it. Sometimes I feel kind of confused, like should I be calling multiple lawyers with that? So what does your lawyer team look like? Do you have one for like private placement memorandums, one for evictions? Like how does that work?
Yeah, I definitely have very specific attorneys for very specific things. I have a specific attorney for private placement memorandums and syndication. I have several attorneys that I like to go to for different types of contracts. I have an attorney I use to fight my tax assessments.
And I kind of feel like you've brought this up multiple times, but you talk about kind of the cost of time. How do you value whether you are going to try to vet something yourself or bring in a professional to bring somebody in? How are you valuing the time versus the money put into that?
Well, there's three factors. There's time, the value of my time, and then my interest or willingness to do whatever it is. There's plenty of things that I could do myself, but I either don't like doing them or it's not the highest and best use of my time. The bookkeeping's a perfect example. Once I got rid of that, that was a huge time suck. And I freed up a lot of time to do other things like build a real estate portfolio by not writing my own checks, by not following up on those mundane bills where you have to call someone to give them information or to coordinate something.
So how early on would you recommend somebody go to that bookkeeper then? Would it be just after, the 1 or 2 rental properties, or would it be after their first large purchase? Like, where would you recommend that?
Look, some people love doing their books, and that's fine. If you are in a position where you are not paying bills or putting off paying your bills for a long time because you just don't like sitting down to write the checks, or you can't find the time to sit down to write the checks or to keep your books, then it doesn't matter whether you own real estate or not, or whether you're beginning or you have 3 properties or 300 properties. Hire someone to do it. The time you save is well worth it.
Now, I know you mentioned multiple times on the podcast you've chosen Green Property Management. What were the things that made you choose that property management company versus others? I know they do the all-in-one, but what other factors did you consider when you chose that property management company?
The team is very important to me. Who's on the team that I know and that I can trust and that I can ask a straight question of and get a straight answer from. And I was already familiar with Green Property Management because Marty Green, who's been on the show, he and I had partnered in a couple of deals. And so I look at the maintenance team. Can I call the head of maintenance? That's important to me. Being able to talk to the leasing agents directly is very important to me because they are part of my team, and I'm part of their team. I like to think I'm part of their team. Am I saving money? There's some efficiencies that end up putting a lot more money in my pocket, actually. But money is not the prime consideration for me. It's how am I going to get along with this team, and are they going to take the best care of my properties, and can I trust them? That's really what it comes down to.
So everybody seems to have an opinion about where we're going, with this economy, and especially the market here in the Grand Rapids where you invest at. What is your personal opinion on what's going to happen in the market? Whether it's your specific asset classes that you're investing in or just in general.
Boy, that's such a tough question, but I give it a lot of thought. I mean, every day, every conversation I have on this podcast is like, what do you think is going to happen? Are we in a bubble? I feel like I have this conversation at least 5 times a week, and my answer changes depending on who I talk to. But,
so let me ask you a different question. How are you going to hedge against the bubble or whenever that might be? So how are you currently planning for that?
Okay, good question. But I do want to answer the question. Do I think we're in a bubble? Probably not. Do I think people are overpaying, especially for multifamily and apartments? Definitely so. Does that mean the market's going to crash and we're going to repeat what happened in 2007? I don't think so. I think there'll be some pain, but it's going to be mitigated by other factors. Correction. More like a correction. Yeah. Okay. That's what I think. Whatever happens, it's not going to look like it did in 2007, 2008. I don't think we're going back to that, at least not for quite a while. I think there'll be a correction, but it'll be kind of a minor correction. Mm-hmm. How do I hedge against, let's say the worst happens and we are in a bubble. How am I hedging against that? Well, I've looked at every property in my portfolio, and I'm doing my best to position it for the next 10 years. So any commercial properties I have, I am either have or am in the process of converting from a 5-year balloon to a 10-year balloon. That mitigates risk right there, because in 10 years, it should even out whatever problems I face in 10 years. However, people who go to banks to get commercial loans know that quite often banks don't want to go more than 5 years. In those instances, I'm refinancing, but I'm keeping a higher loan to value. So rather than pulling out, doing an 80% loan to value and pulling out a lot of money, my loan to value might be 50, 60% on those 5-year balloons, and I'm not pulling out any money. Instead, and I've talked about this on the show, instead maybe I'm creating a line of credit that I can tap into if I want to, but if I don't, I'll still have that 50, 60.
So is that a straight 10-year term, 20, 25-year amortization, or is there some type of reset in there, like a 5-year or 10? Is that like a 10-year commitment with resets at some point in time as well, or?
It depends on the lender you go to. I'm in the process of refinancing a larger property, and by larger, it's like 37 units. And I'm probably going to go with a Freddie Mac small apartment loan. and they will do a 10-year term fixed for 10 years. They also have a hybrid option where after that 10 years, you don't have to refi. It's just the rate will adjust and it will float, a certain amount above prime. But you can lock it in for 10 years. I've looked at a lot of loans lately. There are some banks now that will do 10-year financing. There are some lenders who, maybe they'll do 10 years, but it's floating for 10 years, or maybe it's fixed for 5 years and then it floats after that. I would say if you're looking for a loan, get as many options as you can and go to as many different types of lenders.
What is the amortization that you typically would expect on those?
Well, if you're getting a bank, like a local bank, you're probably looking at a 20, 25-year am. The Freddie Mac small apartment loan, 30-year.
Okay. So let's tie into that. So I've always heard agency debt is always the way to go. Why would that be a more beneficial loan than, let's say, going to a small bank and doing a portfolio loan? Because I think there's a stretch here where all you hear was people talking about portfolio loan and whatnot.
Yeah.
I'm curious to see what you would think would be the benefit of doing one versus the other.
Well, sometimes you don't have a choice. It really depends on how much you're going to borrow. Freddie Mac's small apartment loan, there's a minimum amount you can borrow. So if you're just refinancing a 4-unit or financing a 4-unit, you're probably not going to qualify.
Do you know what that limit is?
No, I don't,
Okay.
and I'd hate to guess, but I talked to a broker who can do it, and not you can't go to a bank and say, hey, I want a Freddie Mac small apartment loan. You need to go to a broker who actually can offer that. So it's definitely something to look into, though, the Freddie Mac small apartment loan. If you're going to be borrowing, and again, I'm guessing here, but I think at a minimum $500,000.
Okay. That's actually lower than I thought.
Yeah, so it's designed for people who own small apartment buildings. Gives you great terms. There's a higher cost to get into it with the fees and everything, but it gives you better terms. The thing is, you need to go through a broker to get it. If you just go to your bank, they're going to offer you one product, and that's whatever they have. Now, I think everyone has a different idea of what portfolio loan means, and I had a guest who described it as portfolio basically means that the bank has their own money that they want to lend out of. They're not.
They don't have a secondary market to sell it off to.
Yeah, they don't necessarily have to conform to that secondary market. And again, I'm not a loan broker. I'm not an expert in this, so I might be off on my explanation. But whether it's a portfolio loan or just whether it's being sold off to the secondary market, on those types of loans, you're probably going to have a 20-year am. You might get anywhere from 65 to 80% loan to value, and it's probably going to be a 5-year balloon unless you can negotiate a 10, in some cases you can.
So at this point, are you personally guaranteeing all of these loans that you do?
The Freddie Mac, I believe, is non-recourse.
Yeah, because I asked that because I used to work in banking, and I remember in 2008, 2009, every loan we did at the bank was a non-recourse loan. But now I feel like today it's commonplace that there's always a personal guarantee. And then in addition to that, too, I'm finding that a lot of the loans are actually asking for a cross collateralization. So I might be getting my loan under MCK Management, which does my flips, but now they're asking for the assets of my other businesses like MCK Rentals, which is just my rental properties.
Yeah.
So I am curious with this because I feel that in your position, you have more opportunity to leverage. And so that's why I asked that question.
Yeah, that's a good question. I mean, I think it breaks down to the smaller the property and the smaller the loan, the more likely I'm going to have a personal guarantee, full 100% recourse. The larger the loan, the larger the amount, the more likely it's going to be a non-recourse loan. That's how I would break it down. And I would be very wary of cross-collateralization. If they're asking for cross-collateralization and they get in trouble, who knows what they might do. I'm looking at a loan term right now where if you really read the legalese in the back of the loan, it says, well, the bank has the right to call in the loan if they feel like they're going under.
Even if the note is performing, yeah.
Yeah, so you have to be wary of loans and that cross-collateralization. Now, I think what you're talking about is if you have other accounts with that bank, they can dip into those accounts, or are you saying that they can go outside of their own, outside of the bank to other accounts?
Yeah.
Oh, that would be very concerning to me.
Yeah. So like, for example, how I structure my, is I have a separate holding company. And so that actually holds the real estate, but I have a separate company because I self-manage that it's a property management company. And so because of the transference of assets, they felt that both were the same company. But then I even had another bank say that they wanted my flip business income as well to guarantee that as well. And so that ultimately was the deal breaker. So because in 2008, I worked at a very large national bank, and it affected me so much to this day that literally I'm probably going to do my first balloon mortgage here or, note in probably the next 6 months. But for the longest time, I wouldn't touch it because I saw so many performing notes get called. And so for me, my preference is I would rather work with a bank that has only $100 million in commercial assets, because they're less likely to call a note performing, because a $10 million loan means significantly difference to a publicly traded company with $20 billion that also has to appease their investors too as well.
Yeah. I would just say, look at the investment that you're investing in. Do you feel that you're overextended on that investment, as in that if the bank were to call in the loan, you would have to, declare bankruptcy or get in big trouble? If you feel that way, then you're probably putting yourself in a bad situation. With the self-storage, when we buy that, they have the right to call in that loan. But if they did, I think we'll have enough equity in the property. Even in the worst of situations, I could go to some of the private investors I know and say, look, let's buy this out from the bank. And I think everyone would still do very well on it. So
are there other loan products do you think the listeners out there may not know of them? It could be useful, because this Freddie Mac small apartment loan that you mentioned, that's the first time I've ever heard of it.
Yeah, the Freddie Mac small apartment loan, very, very interesting. Google it.
Okay. That's over 4 units or over 5 units?
Don't pin me down on answering that. I know that I'm using it on a 37 unit, and with Freddie Mac, there's some different programs as well that would apply to small apartment investors. Of course, when you get to the larger apartments, you've got a lot of you got Fannie Mae, Freddie Mac, HUD. I've gotten insurance loans in the past. Insurance companies like to loan money, especially on strong asset classes like multifamily and apartments and self-storage.
How did you discover that?
Through a broker here in town. There's a broker, Greenman Capital, right here in Grand Rapids. They source a lot of insurance company loans at some very good terms. Once you're borrowing over $1 million, there's a lot better options and a lot better terms out there. With other sources of loans, I may not have done it, but I've talked to a lot of people who've done seller financing, other creatives. There's a lot of creative ways. There's not just one way to get a loan. Don't just go to your local bank and say, hey, what kind of loan can you give me? Talk to a lot of different lenders for the type of property that you're buying.
So have you ever purchased a significantly underperforming asset?
Oh, all the time.
So the reason why I ask that is because in this market, I feel that for example, you might find a storage facility or apartment complex that's vastly underperforming. And I think the rule of investors, we're always told, is to purchase based on how it's performing now. Yeah, I feel a lot of these assets are being valued at their potential or somewhere in between there. So could you elaborate how you kind of balance that? Because I think that's personally one of my struggles I have. So for example, I have an asset right now, I'm evaluating that its cost to build. If I just told you the numbers, it sounded like it would making sense. But then when I look at the numbers, no bank would touch it. It's kind of like one of those things that I'm not really sure how to evaluate that.
The best thing you can find is an underperforming asset that you can purchase off market for the value at which it's performing. That's a very hard thing to find.
I think we're all looking for that at this point.
Especially in this market, it's very hard to find. A lot of times, if the property is being offered through a broker, they've priced in a good, significant portion of that upside. But the good commercial brokers understand valuation, and they understand what it's going to take to appraise, and they tend to have more realistic prices, but they're still higher than what I would like to pay. I think you have to be careful about not overpaying for a property based on its upside. Because if you overpay for a property based on its upside, once you achieve that upside, you still have a property that really wasn't worth all the time and effort you put into it. Unless there's additional upside that you can bring to it. And there's always additional upside. But a mistake that people are making right now is we've had a huge run up in rent incomes over the past 3-4 years. And if people are still overpaying based on an upside that is projecting the same increases in rents, I think that that's a very dangerous projection. Because what we're seeing right now is the market has kind of stabilized, and in some cases rents have actually dipped.
Yeah.
So we're not seeing that increase. And it's we're going into winter, maybe it'll all pick up again. Don't invest on this huge, thinking you're going to get 4 or 5, 6% increases in rent each year. Try to stay at a more realistic 2.5%, 3% increase. There was an auction apartment building in the Detroit area. When you do an auction property, you kind of have to do all your due diligence before you bid, because once you get the bid, you're committed to it. Based on where we felt the value was and what the upside could be, we figured if we could get it for 1.2 to 1.5 million, we could get the value up to about 2.5, 3 million within 3 years. Okay. So we started at our low end, 1.2, once the bidding opened, and quickly we got up to 1.6 because at the last minute, when you do these auctions, you kind of say, okay, we can go a little bit higher. Well, the bidding ended above 2.6.
Oh, wow.
Yeah. And we're pretty sophisticated investors. My partner was from that area, and he knew exactly what the upside was. So they had already paid for the upside. In 2 to 3 years, that property will be worth 2.6, maybe 3 million. But there's a long way to go and a lot of money to put into that property to get there. So they'd priced it all in. Now, maybe they know something we don't, but maybe they were just a little overzealous and paying too much for a property that was really only worth about 1.5.
So do you have a personal preference on, I know you mentioned that right now, as of late, you've been investing in the actual person. Do you have a personal preference on whether you syndicate or passively invest at this point?
I'd like to use as little of my own money as possible. So I'd prefer to syndicate and bring in other people's money. I guess syndicating is my preference. I like bringing other people, other qualified investors into these types of deals because it's an opportunity that I can offer that they're just not going to have the time or the willingness to do on their own.
So by qualified, do you mean accredited?
Accredited.
Okay.
My investors are all accredited.
So I ran into this earlier on. I don't run into this now, but one of the obstacles I used to run into is the opportunities available for investors, especially newer investors that are not accredited to invest in passively, are significantly worse than those for accredited investors. So what would you say to that investor that is, I guess, trying to get there, but they're feeling like they're pushed down? So like, and I'll give you another example. One of the issues I run into is that trying to purchase a multifamily is that I typically am getting the leftovers of the deals that are being sent to people like you. So the broker knows that you will close a deal. They'll send it to you. If you pass on it, then at that point, then I get it, or it goes to the MLS. So what would you say to those people to do, not necessarily to encourage them on what they could do to obviously gain that some type of advantage in that realm?
Wow, that's a good question. Really, the first thought that comes to mind is create relationships and partnerships with those types of people. If you're an investor who's losing out to the bigger investors, get to know those bigger investors. Take them to lunch. See if there's a way that you can work together. Bring them a deal. That's the quickest way to move up to the next level is to partner with someone who's at that level. Because otherwise you might find yourself struggling at that lower level for quite a while. But if you can bring value to that other investor, it will be worth it to both of you to do so. One of the problems a lot of people have that I talk to is they don't want a partner. A lot of people think, I want to do it all myself. I want to own my property 100%. I don't need partners. And that's great. And that's great, but you're going to stay at a very consistent level. If you're looking to build your portfolio and really move up to really a higher level of investing, you need to partner with people who can help take you there.
Have you had any bad partnerships or partnerships that didn't turn out well?
I'm sure I have. Nothing comes to mind. I like working with other people, especially when we have a common goal, and that usually works out for the best. If it doesn't for whatever reason, then we just won't do business ever again. Most of my experiences have been very positive. And I really can't think of a negative experience at the moment.
Yeah, and I feel like you have talked about multiple partners. I feel like I've always heard about one person having the same partner over and over again, and maybe a huge start out, but it seems like you have adopted a number of partners, and you really adopt those partners based off their expertise.
Yeah, definitely. And Marty Green is a perfect example of that. So Marty has been on the show, and he and I have partnered on several large apartment syndications. The reason I sought him out to begin with is because I knew that his company, Green Property Management, was managing the type of properties that I wanted to invest in. So I sought him out specifically because I figured, hey, if he's managing the type of properties I want to own, then this is definitely a person that I need to work with. And I ended up buying an apartment complex and hired his company as a management company. That relationship worked out great. A couple other opportunities came along, and we said, let's do this together. And both of those deals have just turned out to be fantastic deals.
Does that ever get intimidating to some degree, even where you're at, where you're going into a realm where your partner knows significantly more than you do?
Well, I prefer my partner to know significantly more than I do. There's certain things I know that I can bring to the table. There's plenty of things that I don't bring to the table. So I want a partner that complements that. I don't want a partner who's bringing the same things. I want someone who I can look up to and ask questions of and gain a new understanding from.
So what keeps you busy outside of real estate?
Well, the podcast is the number one thing. But next to my kids. So I guess the podcast and my family are the two things that keep me really busy. If I get the occasional afternoon, I might go see a movie, which is nice, having a movie theater to myself in the middle of the day.
Oh, you do?
With a bucket of popcorn.
Oh, okay. Maybe I'll bring my kids over next week.
No, I'm talking during the week when my kids are gone. I might sneak away for a good R-rated movie. I don't have a job, but the amount of time I spend on real estate related matters is, more than what I was spending when I had a job. I'm still very, very busy.
So is there any message that you'd like to give to the listeners out there that we really haven't covered yet today?
And the one thing I wanted to make sure we talked about, you asked me why I'm doing the podcast, and it's all about the RPOA. I wouldn't be doing this podcast if Clay Powell from the RPOA hadn't asked me to do it, and if I didn't believe in what the RPOA was doing, which is a Rental Property Owners Association. Whether you live in Michigan and Grand Rapids and you can join the RPOA, or you're in a different community and you have a REI, Real Estate Investors Club, or some other club, get involved in that. The benefits from being involved in networking with other like-minded investors, the benefits are just, you can't quantify them. The people I talk to through the podcast probably break down to 75-80% of them are RPOA members or local investors who are just actually doing it. No matter what level they're at. I mean, I've talked to people who have done one single house hack with a duplex. And that's a fascinating conversation because they knew nothing about real estate investing, and they bought a duplex and they're house hacking. All the way up to people who have multi-million-dollar portfolios. But I like talking to just the people who are doing it. And that's the great thing about the RPOA is you're going to be around people who are doing it. So get involved. And I'll say this directly to people who are in the Grand Rapids, West Michigan area. Get involved with the RPOA. But the RPOA offers classes, plenty of networking opportunities. They are working very hard behind the scenes on the legal front, the legal and the legislation front, to kind of help legislators shape bills that affect us directly.
Who is that does that for the RPOA at this point in time?
Well, Clay Powell's a big part of that. Yeah. He's staff and he runs the RPOA. There's the Government Affairs Committee, which is Tom Coetsier and a number of other very committed people who are working with the elected officials, both in the city of Grand Rapids and in the state of Michigan, to help shape legislation in a way that is going to be beneficial to everybody, not just real estate investors, but to tenants as well. Any bills that are passed that cost us more money as landlords and property owners are going to raise rents. So let's be very careful about the restrictions and the compliance that we put on real estate investors. But also, I think just being someone who's a member of an RPOA and volunteering for some of the committees. We have an education committee, which I chair. We have a annual conference committee where we plan the annual conference every year, plus the government affairs, plus the public relations committee, membership committee. There's all kinds of ways to get involved and active with the RPOA. And I just like to encourage our listeners to consider that. If you're able to come to a meeting, whether it's during the day or in the evening, take that extra step and do that. Make that commitment to come and be a part of a community that is very serious about investing in real estate, owning rental property, and doing it right in a way that benefits the entire community. Thanks for giving me that opportunity to kind of make that plug for the RPOA.
Brian, thanks for having me as the guest host here today. So hopefully the listeners here can benefit from everything you've talked about. So you've given me a few things to think about for sure. I know I've been balancing whether I wanted to get my own bookkeeper or not. I did actually have one at one point. It didn't work out well, but based off what you told me, I think I will actually go back out and kind of look for one again and see what happens.
Yeah, finding a bookkeeper that works right. I've been through some bookkeepers who I had to let go and try someone else. Once you find the right person, though, it's worth it. It's worth it. You did a great job interviewing me. Thank you. Great job. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers. Learn more at pointcentral.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.